The following presentation will analyse what will happen to the exchange rate of the Australian dollar and the US dollar within the next 3 to 6 months, conducting a forecast on the currency pairs through economic indicators of the respective countries, including inflation rates, growth rates, government intervention, and exchange rates to form a solid opinion on what will happen to the exchange rates in 6 months' time. The current rate of exchange between the Australian dollar and the US dollar is 0.7780, meaning that 1 Australian dollar will buy 77.8 US cents. However, the rate of exchange between the countries, such as Australia and America, fluctuate frequently. So by looking at different factors that influence the exchange rates, we can speculate on whether the Australian dollar or the US dollar will increase within value within the next 3 to 6 months. The first influencing factor looked at are the country's interest rates. With the higher a country's interest rate, it offers a higher return on investment relative to other countries. According to the American Federal Reserve, the US's interest rate is currently at 1.75% and is expected to rise at a rate of 2% over the next 2 quarters. In comparison, the Australian interest rate is currently at 1.5% and should hold steady over the next 6 months, according to the Reserve Bank of Australia. This means that both current and future interest rates will be higher in the United States, which is favourable towards strengthening the US dollar against the Australian dollar. However, the effect of a country's respective interest rate can be overshadowed by the inflation rate, which moves us on to the next factor that affects exchange rates. Inflation rates. Typically, the country with the lower inflation rate tends to have a rising currency value. We found that the United States inflation rate is currently at 2.4%, which is higher than Australia's inflation rate, which is at 1.9%. However, this is only a slight difference, and it is predicted that the gap between the two inflation rates will close within the next 6 months, as Australia's rate is expected to increase to 2.3%, whilst the US's rate should hold steady. This means that there is no significant difference between the two inflation rates, which would impact the country's rate of exchange. A government intervention that could potentially affect the value of the US dollar over the next 3 to 6 months is the external policies Trump is placing over the world. Recent tariffs imposed by Trump, including a 25% tariff on steel and a 10% tariff placed on aluminum in a bid to create more American jobs and, quote, make America great again, could pose a potential change to the American economy via a potential trade war with China. China, in response to the American tariffs, in return, placed tariffs of their own on over 106 key US products, including soybeans, aircraft parts, and orange juice. The US then responded to this, potentially threatening more to come, and China stating they are not afraid to back down from a trade war if necessary. Although there is a potential for a trade war between the two countries to kick off, it is probably not likely to, as it will not benefit either country, with economists expecting that the dueling taxes to have relatively limited impact on the overall US economy. Australia will not be affected from the US tariffs, however, as they currently have a free trade agreement with the US, meaning that the tariffs will have no impact on the Australian economy or value of the Australian dollar, as Australians can trade with the US tax-free. From this, it can be observed and backed up by several economists' predictions that the dueling taxes between the United States and China will have a low impact on the US economy and the value of the dollar, allowing for other factors, including interest rates and growth rates, to be used to predict the value of the US dollar over the next several months, as there is not many government interventions that could ensure a major impact on the US dollar. However, a war with Syria could drastically change the value, although that is unlikely to occur within the next 6 months. A government intervention that could potentially affect the Australian economy over the next 6 or so months could be the fiscal policy with the potential lowering of the corporate tax. If Australia were to lower the corporate tax from the current 27.5% for small businesses and 30% for businesses turning over 10 million or more within the next few months, it may have a negative effect on the value of the Australian economy in the short term, but a positive effect in the long term with more businesses operating within Australia as opposed to overseas, therefore creating more Australian jobs and boosting the economy. It is unlikely, however, that the corporate tax will significantly drop enough within the next 6 months to drastically affect the value of the Australian dollar. It is also unlikely that the government intervention will occur within the next 6 months that will drastically increase or decrease the value of the Australian dollar. Therefore, other factors such as interest rates and growth rates can be used to forecast the rise or fall of the Australian dollar within the next several months, as it is unlikely a government intervention is going to occur that will have a major effect on the value of the dollar.
GDP, or the gross domestic product, is a monetary measure of the market value of all final goods and services produced in a period. When we look at the US's GDP growth rate, it can be seen that it has performed stronger than expected in the previous last 2 quarters. It is set to reduce in the next 2 quarters due to the cyclical nature of GDP, but when referring to the graph, you can see the differences. However, trends expect GDP to remain stable, fluctuating between the ranges of 2 and 3% over the course of the year. Australian GDP has recently, however, underperformed in the previous last 2 quarters, with growth rates of only 0.7% and 0.4% respectively. This is expected to rise substantially to heights around 0.7% and 0.8%, which is nearly double. Looking at the information gathered, it is clear to see that the US have a higher expected growth, potentially meaning that USD will be strengthened to get the AUD. In reflection of all information gathered, it is clear to say the US dollar is going to appreciate against the Australian dollar in the next coming 6 months. This is due to the positive correlation between GDP growth rates and interest rates in the USA, which will then result in the currency of exchange improving. This can also be attributed to the relatively stable inflation rate, meaning there will not be any dramatic increases in the money supply, which will also lead to stable prices. The only macroeconomic factor that could lead to a reduction in USD's value in comparison to the AUD would be government intervention. The instability surrounding the US government and their decisions around trading will likely have a high level of consequences and could damage their already volatile financial markets. However, if President Trump avoids engaging in further trade restrictions, then it's safe to endorse that the future value of USD will continue to rise, meaning going long and buying the stock would be advised as it looks to improve in the coming months, which could lead to substantial profits. Thank you.